Welcome, everybody. It's a privilege to have with us Governor Roberto Campos Neto, the governor of the Central Bank of Brazil. And I would like to begin, Governor Campos, by complimenting you in terms of your reluctance to use the extent of monetary easing ability that the Brazilian Congress has given you. And this is clearly in contrast to what the Federal Reserve has done, for instance. And the monetary discipline that has been shown has been exemplary. Your focus has been on lowering the SILIC target rate rather than quantitative easing. So I think that is great. And second, you mentioned at the Bloomberg conference earlier in the month that the GDP forecasts, your forecasts, were more optimistic than the IMF. And clearly, the IMF has come down to come to the level of yours, and they have raised the expectations for the Brazilian economy. So again, you were spot on. In the limited time we have, I'd like to focus on four items. Your expectations for the path of the SILIC rate, which you began the year at 4.5%, and we sit today at 2%. What the investors and the audience can expect from the central bank in 2021. Secondly, the Brazilian real has had quite a weakness this year, started at about 4 to the dollar, now sitting at about 5.6 to the dollar. So it's a significant depreciation. And Economy Minister Guedes said on Friday that he's very comfortable with the weakness of the currency. So, what should investors expect going into the new year? Third, the minister also said that pandemic related fiscal stimulus should end at the end of this year. If so, is monetary policy going to bear all of the burden itself? Can monetary policy fully substitute for fiscal stimulus in 2021? And your thoughts on that? And finally, rating agencies, in particular Standard and Poor's and Moody's, have either lowered the rating or put it on outlook because of the fiscal spending limits, and what your thoughts are. And those would be great, I think, for the audience to hear during the limited time we have. Back to you, Governor Campos.
Thank you, Mr. Kamal. I'm going to do, and thank you, and welcome everyone. Thank you for the Milken Institute for the invitation. I'll do a small, brief summary of everything, and then we go into the 4 points. So beginning with our recent history, before the COVID, what Brazil was doing was we were in a process of reinventing growth with with the private engines. We diminished the public debt. We were able, because of the reforms and because of this process, to lower rates to a record level. So lower rates in a way meant more ability for the private credit to grow. We had less public debt, more private debt, and this is the process that we were getting in. So the idea was to have this sustainable growth in which you diminish the size of the government, you diminish the public debt, and you increase private participation. Then came the COVID. We were faced with a huge challenge. In response to that, when you compare to other countries, we basically had five things, and I'll go into each one of them. If we look at monetary policy first, we lower rates additionally from 4.5 to 2.5. If you look at liquidity and capital, we basically did one of the largest liquidity injection programs out there, 17% of GDP in liquidity plus 17% of GDP in capital to the financial system. So the financial system in Brazil is one of the most liquid and more capitalized systems today in emerging market countries. Then we go to the third part, which is credit lines. We work together with the Minister of Finance. We design numerous credit programs. We still have a lot of absorption room into the programs that we're designing, and we're seeing that. Then we go to the tax relief, which was about the average, what we did compared to an average emerging market countries. And finally, the direct transfers program, in which the government did the biggest program ever done in terms of direct transfers. We call it Auxílio Emergencial, and basically that changed the way the income distribution happened in Brazil this year. So when you look at all of this, basically, if you compare to other emerging market countries, Brazil spent much more than the average, but also had a bigger reversion of expected growth. If you look at the delta of expected shortfall before and after the measures, we had a big surprise in a way of the economic agents upgrading Brazilian growth to less negative. I think it stands around -4.5, something like that today. So we had the strongest recovery in emerging market countries. If you look at the PMI, we had the lowest fall and the strongest recovery. If you look at consumption, it's pretty much the same. You look at credit growth with all the measures that the central bank did, and we have a credit growth that is around 16%, with credit to companies growing 27%. So it's very important to understand that this channel, credit channel, is what is differentiating countries in terms of the shape of the recovery. But the cost of that was a fiscal risk. We already had a fiscal situation that was fragile from the beginning. We were reversing that, in the process of reversing that, and then we had the big shock. So Brazil had a fiscal slippage that was very high. We understand that this detour was needed, but we need to communicate that we want to go back into fiscal discipline. That's one of the most important points that we have today. The fiscal uncertainty is hindering a little bit the investments in Brazil, and we understand that we are at that inflection point that you need to pass along credibility. We need to resume the original plan to grow privately and restore credibility. And in our case, credibility will be and is connected to fiscal discipline and continuation of the reforms. I'm confident that will be achieved that. Going a little bit to the side agenda that we have, it's important to mention that this recovery has had three common dimensions in almost every country. One is that the society demands it to be more inclusive and more sustainable. So we are looking at that. The second is it's technology induced, and the third is going to promote some change in the global value chains. When you look at the technology part, we think there's a lot of things going on that will change the way we see financial intermediation. One of it, which I always mention, is the convergence of texting, content, and payments. I think this is changing the landscape for what we're doing. The concentration in cloud computing also is something that we're looking at. The tokenization of assets, I think it's a process that will accelerate a lot in the next couple of years. So the reaction of the central bank was not only not to postpone the technology agenda, but to anticipate a lot of it. So we have the instant payment system that starts live next month. We already have 40 million registrations in a week. So I think people are engaging in this very heavily. We have the open banking system that's going to run parallel to that. And we have a modernization of the FX, and the plan is to have three phases: modernization, internationalization, and convertibility. And at the end, all these three things will be connected to our plan to have a digital currency. On the top of that, we have a sustainability agenda. I won't have time to talk about everything, but the idea is to make sure that the financial system is aware of the necessity of financing sustainable projects. So that was my introduction. If you want, I can go straight to the 4 points, whatever you think it's best.
That would be great. Yeah, if you would address the interest rate, the currency, and then the rating agencies and how you would react to it, those would be great for the audience. Please go ahead, Governor Campos.
Okay, so on the Selic rate, it's important to understand that the economy doesn't run on overnight rate. So we fixed the overnight rate, but we need the general shape of the interest rate curve to be flat enough so that the long end rates also induces private enterprise and induces project. We had this problem in the past that we had a curve that was very steep and that was not inducive of projects. So the first thing I would say is it's impossible to tell you whether Selic is going to be the same level. It's going to depend on the macro dynamics, but it's important to have credibility so that whatever we do in the Selic rate has a transmission channel that feeds into the longer end of rates so that projects can be done with private money, as opposed to what we had in the past, which is all the long-term projects need subsidy. So the less subsidy you need, the more the long end tends to fall, and then the more private projects you can do. So this dynamics is very important. In terms of the real, I think we need to understand that we had three dimensions to the devaluation. We have a first phase in which the currency was devaluating with risk premium improving because companies were substituting debt offshore from that onshore, and that has to do with the fact that the long end rates was very, very low. So at that rate, the companies, Brazilian companies, thought it was attractive to have local debt. The second part was a general devaluation in which every country suffered more or less the same. And then Brazil decoupled from the rest of the countries in about 9%. And that, I think, has been more intense in the last of the movement. And that has many elements. One of it is low rates and high liquidity, which tends to make more players hedge using your currency. You have the dynamic of trading, local trading. You have more mini contracts. That has also created different dynamics. You have specifics of the real because we had changed some regulations that created a demand for the currency, and that's called overhedge. And we had the fiscal fragility that also add to it. In terms of the pandemic and what monetary policy can do, I think it's important to understand that we are at this inflection point right now that if we spend more money, if we actually have a longer program, the cost and credibility coming from the fiscal size is far bigger than the benefit of the spending itself. So we are at an inflection point in the fiscal curve that if you want to actually induce growth, it's better to spend less than to spend more because we are getting penalized by markets and we are losing credibility for having such a high debt that's actually creating this uncertainty that is refraining growth from happening because of expectations. So I think it's actually not what the monetary policy has to do in addition to that. I think it's transmitting the message that we are at that inflection point in which doing more means less right now in terms of the recovery going on to next year. And then the last part, which is the rating agencies. I think the rating agents are just like a process of price discovery, and it's important to have that. When you mentioned that Brazil didn't use the instruments, and we were very, very careful using the instruments that were given to us because we didn't want at any time to eliminate a process of price discovery. We think prices have a very, very meaningful information for policymakers, and if the price discovery trajectory is reflecting our fiscal problem, I think it's important to understand and realize that. And instead of fighting against that, it's better to fix what the problem is, which is the fiscal slippage. So I think the ratings are just like a process of price discovery. We understand they are worried about the fiscal situation because Brazil does have a fiscal situation that is more fragile than the average emerging market countries. What we need to do is to tackle that. We were doing that before the crisis. We actually surprised on the level of debt at the end of 2019. And then we had to go into this process of facing the pandemic. But I'm very confident that we will be able to go back into the fiscal discipline, into the trajectory that we initially had. And we need to communicate more with the investors, tell the investors that we have a huge agenda of projects that will bring a lot of inflow into Brazil. We have infrastructure projects. We have projects for basic sanitation. We have, when we talk to people who are actually looking at projects in emerging market countries, Brazil has today one of the biggest portfolios of projects available. So what we need is credibility to make sure that this money comes into Brazil, because this is what's going to equilibrate the effects. This is what's going to make us grow with private money. And then, to end, I would probably say a statement that I like a lot. Brazil has the habit of trying to find public solutions for private problems. But what we need to do is to find private solutions for public problems. So that would be my statement.
Governor Campos, thank you very much. I think you addressed some of the topics of great interest to the audience, and we appreciate very much your taking the time. Thank you again for being present with us today at the Milken Global Conference.
Thank you so much. It's an honor. Thank you, and thank you for all the participants.
Hello, everybody. Welcome to the Emerging Market panel at the Milken Global Conference. We have a great team for you. We have asked all the speakers to limit their initial remarks to 4 minutes each so that we may have a lot of time for your questions as they come forth. The great panel includes beginning with Bart Turtleboom, who is the CEO and Executive Director at APQ Global, who will speak about take a flexible macro approach to the emerging markets. He will be followed by Lillian Zhou, managing partner of Yulan Capital Management, who will speak about Asia and in particular about the promise of China that she sees. Third, Raymond Sagayan, who is the CIO of fixed income for Pictet Asset Management. And Ray will focus more looking at the fixed income market in China, the attractiveness of it. And finally, we end up with Oscar Falgren, who is head of Brazil for the Mubadala Investment Company. And we would get a good view on Brazil. So we hope to get a good panoramic view of the emerging market as a whole. So to start it off, Bart, let me turn it over to you to give more of a 30,000-foot view of where you see the emerging markets with low interest rates and with the pandemic affecting all of us around the globe. Bart?
Good morning, Sri, and thank you very much to all our friends at the Milken Institute for the invitation to participate in this panel. It would be blatantly way too obvious to say that we live in a world of great many firsts on the back of the pandemic crisis that we are currently witnessing. But one first, which I do believe is of significant relevance for the impact of the COVID crisis on emerging markets, is that we are living and are likely to live for the next 3 to 5 years in an environment of zero or negative interest rates in the G7. You look at Japan, you look at Europe, you look at the US, you look at various other countries. We are, in terms of monetary policy, truly at, I wouldn't want to call it at rock bottom in rates. Switzerland has told us that the rock bottom can actually be quite far from where we currently are. But nevertheless, we are living in an environment where the interest rate environment is going to be one of extremely low rates, and not just low policy rates, but also low long-term interest rates. Now, when the pandemic struck earlier in the year, I thought something quite instructive for emerging markets happened fairly immediately in the US. What we saw was a wave, as a matter of fact, a record wave in March and April of issuance of corporate debt by investment grade companies in the United States. And why was that? Well, first, there is what I just mentioned, the low interest rates. Secondly, we also had an announcement by the Federal Reserve that they would be active in the investment grade, and then later on they also mentioned in the foreign agent space. So investors quite rightly saw that they would have a Federal Reserve backstop as an intervention in the investment grade market. But what I think is interesting for emerging markets is that the issuance mainly came from the better capitalized, very large investment grade companies in the United States of America. And again, that makes sense. And it makes sense because at the end of the day, unlike fiscal policy or unlike transfer policies, what we are witnessing is the deployment of what is in effect a very blunt instrument that targets the average consumer and the average company in the United States through monetary policy. And what that is, in my view, leading to is a situation where the strong become stronger. Clearly, the economy has the potential of becoming more oligopolistic in the US. Certainly, the equity market is pricing that prospect with a significant outperformance of a very narrow set of companies. If you look at the major indices. And coming to emerging markets, I feel we are going to have the same impact there. We just heard Governor Campos from Brazil. Brazil is one of the larger emerging markets. They have a highly sophisticated financial system. They have highly sophisticated financial markets. They've deployed the full arsenal of monetary and fiscal policy, and as he mentioned, with a reasonable degree of success. Now, it is one thing to be Brazil. It's another thing to be India or China. Those countries have deep internal markets, have large domestic markets, have sophisticated financial markets. But if you're a smaller emerging markets, if you're Ivory Coast, or if you're one of the smaller countries in Asia or Latin America, the situation is altogether a whole lot more dire.
Let's stop there. You can come back with as questions come up and turn it over to Lillian to speak about Asia and China and take us into that region, please. Lillian?
Hi, everyone. Good morning, good evening. Thanks for having us here. My name is Lillian Zhou. I'm founder and CIO of Yulan Capital Management. We are an Asia-dedicated fundamental long-short equity fund with a focus on the Greater China region. So when we look at the policies around the world today, many governments took very aggressive measures in monetary and fiscal policies as a response to the pandemic, as mentioned by all the prior speakers, and rightfully so. The Chinese government took a slightly different approach. The government reached a conclusion fairly early on that the crisis started with the virus and therefore has to end with the virus. So the policy has been very heavy-handed in healthcare measures, including mask mandates, travel restrictions from very early on, social distancing, contact tracing, and the unique cultural and political regime in the country also allows effective implementations of those measures. But in a relative sense, though, the country is actually much more light-handed when it comes to monetary and fiscal stimulus. The PBOC did 2 cuts in reserve ratio in March and April, respectively, and also a total of 30 bips cut only in benchmark rate. By all means, those are meaningful policy responses, but they are very moderate when compared globally. So here's a slide, if we can pull up the slide that we prepared for the recovery trajectory in China across sectors. So you can see, pretty clearly, this is a classic V-shaped recovery, as most sectors are well on their way to recover by April. Production metrics are the first to recover. Thanks to the containment of virus, people generally feel pretty safe to go back to work. And thankfully, global demand has actually held up okay. Consumers globally have more purchasing power to buy from China, actually, thanks to the consumer-centric stimulus policies in many developed countries. Property sales are also exceeding pre-pandemic levels, consistent with many countries, helped by lower rates. Domestic flights recovered 95% by September. Domestic consumption is the one area that's actually lagging the other parts of the economy, because China is one of the few countries who does not try to stimulate by putting money directly in the hands of consumers. But with auto sales gradually recovering in recent months, as we can see on the chart, consumption as a category actually turned slightly positive year over year in August as well. We can close the slide now. So the very different approaches in policies and economic outcome has a lot of ramifications for equity investors like ourselves. First and foremost, we are bottoms-up stock pickers. Global markets have been a challenging market condition for many stock pickers because the markets are dominated by monetary and fiscal policies. Markets, you see a lot of distortions basically by exogenous events as well as subsequent monetary and fiscal stimulus reactions rather than company-specific fundamentals. Factor selection and sector rotation become major drivers in many markets versus stock selection. In Greater China, however, we observe less distortion, both because the pandemic impact is more temporary, but also because the policy have been relatively mild. It creates a more normalized environment, if that still exists today, where the fundamentals actually do matter and allow stock pickers to really find alpha on both the long and short side. The alpha opportunity is further amplified by the fact that the Chinese market remains to be very under-researched. It's a huge and liquid market, over 4,000 stocks listed. The daily trading volume on some days are 5 times that of New York Stock Exchange, thanks to the very high retail participation in the market. 85% of retail volume trading is driven by retail in China. And 40% of stocks actually do not have research coverage. And therefore, the market remains to be very under-researched and has ample alpha opportunities. So big picture, to sum up, it's an economy recovering relatively well, a stable currency anchored by very disciplined monetary policies, a very under-researched stock universe, and you combine those factors with the fact that the Chinese equity as an asset class is generally very under-allocated by global institutions. And that's where we see the big opportunity.
That's great for the introduction. And I'm sure the audience will have more questions for you specifically on the Chinese equities, Lillian. Let's go over to Ray to talk about the Chinese fixed income market in particular. Ray?
I have 4 convictions which I'd like to express, and they relate to the 4 slides which I've prepared. So if we could get the first slide up, please. The Chinese bond market is a $16 trillion market. It's now the second largest bond market in the world, second only to the US. And of course, that's reflective of its status of being the second largest economy in the world. You will not find another sovereign which is A+ rated, yielding 3%. Right now that represents around a 250 basis points pickup to treasuries, which is at a decade high. We've also seen a significant inclusion in the various bond indices, the most recent one being the FTSE Wigby, and market access has improved considerably in the last 3 to 4 years. And when we consider that against the backdrop of a renminbi, which is only likely to gain more prominence as a reserve currency, it's interesting to observe the behavior of Chinese onshore bonds in both crises. We've seen positive total return performances, which stand in stark contrast to other asset classes. If we move to the next slide, please. The next aspect I'd like to address is the extreme growth in the emerging hard currency corporate space. And to all intents and purposes, this relates to primarily US dollar debt. This is now a standalone asset class, which really should have a much broader following. It is now bigger in size to the euro high-grade market, the US dollar high-yield market by a significant margin, and it's been one of the fastest-growing asset classes since the global financial crisis. I think what's interesting here is actually looking under the hood. The credit quality is very different. When you compare that with developed market corporates, leverage typically in the emerging corporate space is typically between 1 and 2 turns of leverage lower. And right now we're at a very interesting point in the credit cycle where we are starting to see some defaults both in the developed and the emerging side. But really, recoveries are very, very different. Recoveries in emerging corporates are typically, in the last 12 months, coming in at around 40%, which stand in stark contrast to developed market high-yield recoveries, which have plummeted to around 17% because of weaker covenants and protection. So this is certainly also a market worthy of consideration. Let's move to the third slide. No discussion would be complete without addressing ESG. And here I've displayed, it's a pretty simple chart using the JP Morgan ESG index, the MB index, versus the non-ESG version and looking back over the last 7 years. What we can see is the cumulative effect in the return profile is very different. I appreciate this is sensitive territory as we commingle ESG factors with the potential promise of returns. But I think in the emerging world, just because ESG factors are so strongly correlated with GDP and the gaps between your laggards and your leaders are so huge, the potential for alpha is huge. And it's not a bad word, but it's certainly worthy of commenting at this point. So I think in the emerging space, and particularly in hard currency, a very sound ESG approach can lead to better returns. And that's the third conviction I'd like to express. If we move to the last slide, please. Think of the emerging space simplistically as comprising 3 different sub-asset classes. So you have your emerging debt hard currency space, the sovereigns, the MB if you like, the SEMB aspects, which are emerging corporate bonds, and the emerging
Raymond,
local currency space.
Let's come back to that toward the end so that we can also give an opportunity to Oscar to talk about Brazil. Oscar, please go ahead.
Thank you very much, Ray, and hi everyone around the world. Many thanks to the Milken Institute for the invitation to talk a little bit today about Brazil. I think we've heard a lot of interesting data points. First from the central bank governor, and then from you guys around the world on the different emerging economies. I think in Brazil, in our experience, we drive a fairly large private investment program on the ground in Brazil. And there are 3 questions that we need to look at today that is on everyone's mind when we talk to investors. One is obviously COVID. The second one is FX, and the third one is the political risk / turmoil that we're seeing on the ground. From our perspective, if we start with these very quickly in this opening remarks, if we look at COVID, we see, Latin America and Brazil today account for 40% of the daily deaths of COVID, so a very headline-grabbing number. What we see on the ground, however, is a situation that leads us to believe that Brazil is further on in its COVID curve, if you wish, that the recovery is coming fairly strongly. And we have a few data points that we can look at on the ground. For instance, we sponsored COVID hospitals early on in the crisis to help people get treatment. Those have been dismantled because there are no patients left. We have infrastructure assets around the country where we see traffic is now rebounded and is actually above pre-COVID levels. So a pretty remarkable recovery considering that people are still partially working from home. All in all, we believe that Brazil will fare fairly well in this COVID situation and is coming at it probably ahead of developed countries. If we look to the FX, as we heard earlier, it's been an incredibly volatile period for Brazil. We had started the year with an FX to the dollar of around 4, and we came almost as low as 6. We had a 50% drop in the FX in a 9-month period. We today stand at around 5.60 to the dollar, so still very, very low. We think this is largely driven by a number of things, including obviously COVID, but also the fact that interest rates are at 2%, and the carry trade from foreign institution that was always backing up the Brazilian FX when interest rates were 10 to 14%. Today they're 2 to 3. We've seen big economic monetary outflows out of Brazil and back to the US. I think the important thing for us here, our takeaway and our stance on this is FX and asset values tend to trade and be driven by short-term headlines and political turmoil. But we believe long-term asset values in emerging markets like Brazil are driven by underlying economic growth. And we are fairly confident that that is coming back at the back end of this year, and then we'll see how it goes into next year. Thirdly, a few words on the government and the political turmoil. Clearly, Brazil has a fairly contentious president in terms of statements that seem to be market standard nowadays for large countries. But when we look underlying the policies that his government and Paulo Guedes are driving, they're very pro-market. The reform agenda is pro-business, pro-market. The central bank is acting in a responsible and growth-inducing way. So we remain quite bullish on the current administration. We do not believe that we're going to have an impeachment. We actually think, if you read the U.S. business press, you see an environment where you think an impeachment or possibly a military coup is around the corner. We do not believe that at all. We think Brazil, by local standards, is actually sort of reasonably stable right now.
Oscar, let's stop there and so turn it over for question and answers. There are already a number of questions which have come forth. Let me begin with the first that we have. I think several of you might be able to answer in some detail. The question is, what does a second wave of COVID in Europe and the United States mean for global growth in general and emerging markets specifically? So if there is a second wave, third wave, what does it mean for emerging markets? Perhaps, Bart, since you are talking about the emerging markets as a whole, get you started and then see who else may be interested with their views. Bart?
Look, emerging markets have truly grown very rapidly compared to the G7 over the past 30 years, and depending on how you all measure it, clearly are now 50% or even more than of world GDP. So to the extent that we have a second or a third wave in the US and in Europe, that is going to have negative impacts on growth in those countries, and that is going to have a negative spillover effect on emerging markets. How severe it will be is going to depend on the response from emerging markets. I would say it's going to be very differentiated between countries that to a large extent depend on exports to the G7, which will be pretty badly hurt, versus those who have strong internal markets, a strong COVID containment response, who will be more immunized, as evidenced by the numbers coming out of China.
Excellent. Great. That was a concise answer. That's great. And Lillian, would you like to tackle that for China?
Sure, I'll probably answer in two regards. Number one, in terms of the virus itself, I think the government in China has really got it down to a science. So, over the last few weeks, there has been here and there has been outbreaks, but they were able to tackle it like through social distancing right away using very aggressive testing measures, and they were always able to put it out pretty quickly. And I think that's not a major risk in my mind for China in general. And in terms of, economic ramifications from, second waves globally, I think obviously the elephant in the room is you will be worried about exports and trades. But surprisingly, actually, for example, in September, we are seeing China exports, hit a record high. It's up 9.9% year over year. And a big part of that is really because, China's back to work. That's the only part of the supply chain that's not being disrupted. While at the same time, global consumers have the stimulus check in hand to spend, and China becomes, the production house for the world again. And I think, as long as the stimulus checks keep coming to Western consumers, the exports will be okay. And China actually benefited from a lot of the disruption of supply chain in many other countries that were manufacturing for the world.
Thank you, Lillian. Ray, there is a question which has come specifically to you. The question is, what are the specific risks that you see, areas of concern for your optimistic thesis? And are there specific pain points that you would watch for? What would you watch for in terms of risk that may spoil your optimistic expectations?
Thanks, Sri. Maybe first relating to the Chinese bond thesis. It's an ongoing risk. I think domestic investors also overvalue the implicit government guarantees, and it's very important to do your own credit homework. Local ratings are inflated, and that's an ongoing risk and an opportunity at the same time. It's also fair to say that in the world of emerging corporates, even with that implicit support, there can be mark-to-market volatility. We've seen recently the situation of Evergrande, and many people think this is too big to fail, which is probably the case. But it does underscore the need for credit fundamentals and to do your homework. That trafficking in these spaces aren't going to be devoid of credit landmines from time to time. So I think you really need to do your credit homework and have a longer-term perspective in terms of the investment horizon. And then the final aspect I would say is the DSSI situation with regards to debt service suspensions, which the G20 is now extending to many smaller emerging countries. I don't think it'll necessarily be disruptive, but I expect this to remain topical for the months ahead. There are 73 countries in the emerging world who are willing and able to receive that relief. And I think we need to look at that in the context of prior emerging restructurings. We've seen restructurings in Argentina and Ecuador in the recent past, which have proved to be relatively bondholder friendly. But there will be some volatility in this space, although we don't expect that, and I certainly don't expect that to have a broad-based effect. So those are some of the things which I'd look out for.
Excellent, great. And Oscar, in terms of a question for you, the governor painted a relatively optimistic picture in terms of the ability to deal with fiscal excesses, what he has done on the monetary policy. Do you think that is sufficient to prevent a rating downgrade? What does that mean for the cost of capital for Brazil in 2021, 2022?
Yeah, listen, I think whether it gets downgraded or not is always hard to say. I think they're driving the right policies. I think when we look at the cost of capital for Brazil, we can see two things happening at the same time. So you've seen an incredible risk on trade by local investors that have been used to earning a high yield on their fixed income investments. They're now shifting to equities, and they're quite yield hungry. So the cost of equity on the market is surprisingly low. What we see from the outside looking in as foreign investors you see much more skepticism to Brazil. We're finding ourselves in an environment where the public markets are quite buoyant and the cost of capital is reasonably low. But on the private side, a lot of people have pulled out, and you're able to find very high yielding opportunities. When we look at Brazil relative to the globe, quite frankly, we don't see that type of yield anywhere else that we can find in the Brazilian private markets.
Excellent, great. But a question came up specifically for you. You spoke about the widening gap between small and large emerging markets. What does that gap between the small and large emerging markets mean for portfolio allocation of investors and in terms of foreign direct investments going into these countries?
It's going to lead to more dispersion, more ability to generate alpha, but also, to the points earlier made, is also going to increase certainly in credit markets, more of the extreme tail events that come from restructurings and defaults. I mean, if you look at the last World Economic Outlook projections from the IMF, what you see is one of the widest dispersions forecast for growth across the world. That incidentally includes the G7 as well. With macro factors in emerging markets, such an important component of returns in equity, local bond markets, and hard currency markets is going to be a very significant challenge. We just heard about restructurings in Argentina. We're looking at, obviously, Venezuela. We're looking at Lebanon. We're looking at the wide swath of African countries. And the environment for those countries is going to be very challenging, whereas for some others, like India, like China, like Brazil, they'll probably be the beneficiary of very low rates for an extended period of time and very good equity returns.
Great. And the elephant in the emerging market room, so to say, is the presence of China, which is growing increasingly dominant. So I'll throw this question forward to whoever may want to answer it. Looking at the US-China relationship, to say that they are not friendly would be an understatement, and they seem to be getting worse as the US elections approach. What do you see, and how does that affect the China risk and the ability to attract foreign direct investments and US companies, European companies locating in China? Raymond, would you like to take it up?
Sure. I think, Shri, irrespective of who wins, there are around 400 bills in Congress floating around, which are of an anti-China rhetoric. So, whoever wins, I don't think this situation is really going to go away in a hurry. But I think what's much more crucial is the changing dynamics between China and the rest of the world. If you take the emerging world, emerging markets are now, from a GDP and a currency perspective, extremely highly correlated. GDP is now 50% correlated with China's GDP. If we rewind to the GFC, that number was only 10%, and it was 60% in favor of the US. So I think the fortunes of the emerging world have progressively become delinked from the US, and I think are much more important to set the precedent for China to really perform on a standalone basis. I think this is a very, very crucial aspect. And also, when we think about China's role as a reserve currency, it is under-owned by most. It's only 2% of current FX reserves globally. But really, if you think about it as a share of world GDP in terms of the correlation with other economies and the currencies, that number should be much higher. It should be really up to about 15%. So we think the standalone characteristics of China and how it interlinks with the rest of EM is a significant development in the last years and will continue to be extrapolated going forward. And that's a game changer.
Excellent. Thank you. Lillian, we heard just today, Beijing time, last night in the United States, that Chinese growth came at 4.9% in the latest figure. It was below expectations, but it's still continuing to grow. How does that affect your selection, or are you bottom up that you do not worry about the macro number?
Well, no, I think it's a great question. I think, as bottoms-up investors, we obviously are aware of what's going on a macro level, because the macro, at the end of the day, that's an aggregation of micro, right, which is what we care about. I think GDP target, is obviously, I think the 4.9 is actually a pretty decent number, but, the number in itself actually means a lot less than it used to. And, China is actually making up its 14th five-year plan right now, and it's going to be announced later this month. And I do believe, we wouldn't be surprised to see more flexible in terms of description of a particular growth target. You might not even see a precise range this time. And I think, it matters less to stock pickers, but, it's actually better for the growth rate to gradually decline as a stock picker, because, when you have a market, an economy that's one way straight up, it lifts all boats. It's just very difficult for us to differentiate the stocks, especially on the short side. So, in a more modest growth environment, it's actually much better for stock pickers like ourselves. The most interesting thing in the economy, again, is not the overall growth. It's really the structural changes, whether it be China's changing relationship with the world, or internal structural changes, reforms that's happening in the country. Those are the most interesting thing in pockets of the economy that we think where the most attractive alpha is.
That's a great answer. Thank you. Here is the question generally on all emerging markets. Several countries have taken dollarization measures, or they are thinking about doing them. And the question is, does that reduce the amount of investor risk if there is dollarization? And which countries do you think are suitable for dollarization? Perhaps, Bart, start with you to give a panoramic view and then see if any of the other panelists would like to pick up.
Yeah, but before I pass it over to Raymond, who I'm sure will have some very pertinent credit views on this. I mean, the history of dollarization in emerging markets is obviously one of totally back against the wall, hyperinflations, no hope left kind of situations, right? You look at an Ecuador, you look at a Zimbabwe, you look at a Venezuela. So, I mean, this tends to be often, not always, but often a reflection of extreme and extraordinary distress in the domestic. So I wouldn't really say it's a particularly good sign. Having said all that, what we will see also is, to the extent that some countries make more active decisions on that front, I am not sure that taking the dollar as your means of payment, store of value, and unit of account is going to be a very wise policy over the next 5 years, given how different the prospects are for certain emerging markets than the US. But Raymond, I don't know what your thoughts are.
Ray, would you pick up on that?
Yeah, I would contend that we are seeing a trend towards increasing dollarization. I would argue we've probably seen the peak of dollarization, especially from a transactional perspective. Again, if we think about the world in currency zones, and where you look at the correlation of GDPs and currencies with each other, the US now really represents about a 40% share, the dollar block, if you like, if you think about it from a currency zone perspective. Yet, in terms of global shares of FX reserves, it's at 60%. Whereas if you take the same measure in China, the real impact should be in the region of around 25% if you account for, as I said earlier, the many different economies' correlation in the GDP and their trade linkages with China and so on and so forth. Yet the share of renminbi as a share as a percentage of FX reserves is only 2%. That to me is completely unsustainable. You've got 60% with the dollar on the one hand, and 2% with the renminbi on the other hand. That's unsustainable, and that's got to converge. So I would actually contend in the first place that we're going to see an increased dollarization aspect. But the other way to look at that is also many EM countries are commodity exporters. And of course, from a perspective of a secular decline in the dollar, that can also be fairly temporarily boosting for those commodity producers and those commodity prices at the same time. So I'd maybe look at it across those two lenses.
Yep. Thank you, Ray. Here, Oscar, a question on Brazil, and you have the central bank president, economy minister, who are both very highly regarded, disciplined, US educated, and when they are conducting policy, but Brazil also has a president like none other that we have seen in history, whether under the military rule or democratic administrations. Can we expect the economic policies to continue next couple of years? Can investors who have put in 50 to 55 billion dollars of foreign direct investments into Brazil every year, are they misplaced? Are they going to be rewarded in the next 2 or 3 years? How do you see it?
Yeah, thank you. Listen, first of all, I think, let's start with the factoid. So Brazil has had 36 presidents. 12 of them have finished their term. So by local standards, we're actually having a fairly stable environment. And I think when we turn to the current administration, I think the economic agenda is deeply rooted in the administration. We don't see, even in an extreme case of an impeachment, we don't see that the next layer would change the economic agenda. We believe there's a fairly broad buy-in for the first time in Brazilian history to the reforms that are being put in place. So yes, I think you can expect to be rewarded in that sense. That is certainly our bet. We believe that Brazil will come out strong, and these economic reforms will, ultimately be passed and implemented. Were they slowed down by COVID? For sure. Is the president contentious? Yes, but he has a very strong, second man or finance minister in Paulo Guedes, and the policies that he are implementing, are things that we think are very, they're right for the country, and we're going to see that going forward.
Great. Lillian, let me pivot back to China. And what we saw in the numbers coming forth is that not only manufacturing output picked up, but consumer spending seems to be getting vibrant again, which was not the case with the initial part of the Chinese recovery in the second quarter. Are you looking more for the Chinese consumers to continue with the support? And what does that mean in terms of stock picking and where you would invest?
Yeah, let me probably just broaden that, in terms of just talk about kind of the long-term structural trends we're seeing in China, and that will include both your manufacturing and consumer, if that works. So, when we are looking at investing in this country, right, we are not looking to really, for the short-term trends. We're looking really for long-term trends that we think are inevitable, will unfold over the next few decades. To use a simple analogy, when an apple falls from a tree, there is a lot of factors that's going to affect that trajectory. It could be the wind, the humidity, but those are noises, right? At the end of the day, it's gravity that really dictates the movement, and we are going to invest in gravity. And for China, those gravities are consumption upgrade, like you mentioned, manufacturing upgrade, technology upgrade. So we will see all of that. And that's not just something that's mandated by the government, but it's actually something as the natural evolution process of an economy that's bound to happen. The current events, including the pandemic and geopolitical tension, is really accelerating those trends. So for example, you mentioned consumer, right? Because of the travel restrictions that's posed by the pandemic, you actually see Chinese people can't go out and shop anymore. So you see a lot of reshoring of those consumptions onshore, and which is what we see, the consumption numbers start to pick up. And, the trade tension is another example, which you mentioned in an earlier question. It resulted in a lot of restricted supply in higher end components to Chinese manufacturers. So out of survival instinct, it's really forcing the Chinese company to search for domestic alternatives. And in the process, that process is going to cultivate the manufacturing upgrade within the Chinese supply chain. So it's really much creating and accelerate that in China, for China dynamic over the long run that will be important driving force for the economy going forward, and it's also an important driving force for investment for us.
Thank you. Bart, you spoke about all of emerging markets, so this question must be for you. The emerging markets have benefited from very, very low interest rates in the United States, Europe, and Japan, so the money flows into Europe, in the emerging markets. If there is a second or third wave and the developed countries hit pretty badly, is it still possible for emerging market equities debt to do well in that atmosphere when the global recession continues into the new year?
I think it is. counterintuitive as that may sound based on my answer earlier on the negative impact on the GDP of emerging markets. But my feeling is that the liquidity effect will dominate. The Fed controls to a certain extent how much money goes into the economy. So does the ECB, but it does not control where it goes. And I will believe that it will continue to benefit emerging markets, not currencies, but certainly hard currency, debt, and equities.
Thank you. Ray, you made the case for for investing in renminbi bonds and the attractiveness of it. But then let's bring in the issue also that some companies may be declared as unfriendly or unfavorable to China, and then there might be restrictions. Even though the economy is strong, do you see political restrictions limiting foreign investment in the fixed income market in China?
I think, as I mentioned before, that qualitative backdrop is here to stay, and we're always going to get that noise around specific companies. I think what matters most is the scale, the size of the market, and to what degree it's been opened up to foreigners. And here, I think the Chinese have made significant strides in the past 3 years to liberalize both the bond and the equity markets, and in particular the bond markets. You only need to look at the CIBM and the Bond Connect schemes now, which are a big breath of fresh air relative to the very early and archaic ways, very almost a quota-driven means of investing in onshore China. So I think those are big game changers, and I think that's going to be the overriding dynamic, which shouldn't really be derailed by political posturing, if you like, which is going to be centered around certain names. I think with these schemes now, you have full access to the market. There are no repatriation risks and restrictions. You have Hong Kong-based custody as opposed to onshore custody. And I think for me, structurally, that's the more significant driver in this equation.
Great, thank you. Oscar, since you cover all of Latin America for Mubadala, let me ask you a question on another key country, on Mexico. Given the close links that the country has with the United States, and again, all the stimulus we have had from the US side, from the Federal Reserve, and from the US Treasury, you would expect the Mexican peso to behave better and for the Mexican central bank to have not as many difficulties with the interest rate determination. How do you see the Mexican setup, the attractiveness for foreign investors?
Specifically on Mexico, we don't see an opportunity right now that we find particularly attractive. If we look at Latin America as one continent, which is how we think of it, we think it is very, very clear when we look at the relative economies that where the outsized opportunity is right now is in Brazil. So do we have a perspective that is positive on the Mexican currency? No, we don't. We think the most oversold currency is Brazil. And we think that where we see the most attractive opportunity to achieve that outsized emerging market yield is in Brazil. So all our activities today, when we look at the opportunity set across the continent, leads us back to Brazil. Every time we evaluate opportunities in other countries, come to the relative risk-reward trade for us is today very firmly in Brazil. We think it's been out of favor for such a long time. It continues to be out of favor in the global economy and the global community. And fundamentally, we don't see the reasons for why that should persist.
Great. I think, you make the case for Brazil very clearly. Thank you. Bart, since you look at different emerging markets, let me refer to one which we haven't covered, and that is Russia. And again, it is a country which has a contrast between a highly regarded central bank governor and at the same time political issues with the West. And how do you see the opportunities in the Russian market?
It's a challenging one to assess because it's very clear that the Western policy of using sanctions to bring Russia geopolitically to the table over matters like Ukraine has clearly failed. And it's failed within the context of fairly volatile commodity prices as well, which haven't really helped the economy. So you're absolutely right. The macroeconomic framework is reasonably intact in Russia. It's been totally hammered. It's an economy that really, coming back to what Lillian said earlier on China, that has really found it extremely difficult to actually diversify away from resources and oil and gas, and hence my feeling is there is a bit of a fixed income opportunity, but not massive in the context of emerging markets globally. And on the equity side, it's really a commodity play.
Okay. Again, it's been said, I think one of the speakers said today that the emerging market GDP is approaching 60% of the world. In other words, it is becoming a bigger and bigger part of the world. About 10 years ago, emerging markets were 50% of the world. And of course, the big part of the emerging markets is the Chinese share, but the other countries have grown as well. And according to the calculations at Bloomberg, the two major contributors to global growth first are China in terms of the participation, and then India, the second, the percentage contribution are the greatest. Why do we still see the capital flows still not reflecting that, the fact that these countries are getting bigger and bigger? And again, Lillian, if you'd like to start off on the Chinese side, and then we can go to look at other parts of the world.
Of course, it's the greatest contradiction, right? Like, and it's gonna be resolved eventually. And I think historically there just has been a lot of restrictions. First you have the QFII quota. There's a long list of requirements that goes into who qualifies for as a QFII institution, and then there is a huge repatriation problem with the tax and all the procedures. It's a really long process, and that's a major hurdle, I think, for a lot of global investors. But let me tell you this: I think I have been following Asia equities professionally for 15 years now. And this is, I think, the capital market, including the stock market and the bond market, is of unprecedented importance to the Chinese government right now. Because historically, the government is overly reliant on bank financing, and the banks are very reluctant to fund innovations, which the country desperately needs, as part of the geopolitical tension that's going on. So their answer is having the market force take over, and that includes both the stock market, the bond market. Those will take over as the main funding channel for the country. And to do that, they have come a long way in the financial and capital market reform, from push for increased weighting of China A share in MSCI index to inclusion of RMB bonds, in major indices that Raymond referred to earlier. And just, they've been keeping making those changes. And most recently in May, the CSRC published the guidelines to remove QFII quota, to simplify the tax and audit procedures for repatriation, which are removing, the major obstacles for global investors. Granted, they still have a long way to go to open up the market, but the direction is very clear, and it's just a matter of time, for that gap to really narrow. And it's a great news for global investors because, when you have easier access, it's really helped to accelerate the process to institutionalize the onshore equity market, which is 85% retail driven now. And that means, more like-minded institutional investors like you guys will be coming into the market, and that will be increasingly move the price in the market in the direction that we want to see.
Thank you, Lillian.
Could I add to Sheree? Could I add to Lillian's comments, please? Because I think Lillian's spot on.
You can. Before you do so, Ray, a specific question came to you from the audience. So maybe you may want to answer that as you respond to Lillian. And the question came from the audience is, why do you feel so positive about the renminbi yuan exchange rate? And you referred to a RMB zone, and can you elaborate on that concept?
Sure. I think I touched on the latter point a little bit, but I'll come back to that. But just, I couldn't agree more with Lillian. And for me, it's down to market access. And China and India are two interesting and completely contrasting examples. If you just take the Chinese bond market alone, ever since we've had bond index inclusion, first starting with the Barclays Global Ag Corporate Index and the JP Morgan Index as well, and then most recently the FTSE Wigby, the cumulative effect of that is likely to be around $300 billion equivalent. We've probably only seen about half of those inflows. Just in that short period of time, in that last 1.5 years, we've seen foreigners now own 10% of the Chinese government bond market, which is a pretty significant jump, given that overall ownership of Chinese bonds is down in the very low single digits, in the region of about 2%. And that's where China and India starkly differ. India hasn't liberalized the local bond markets in anywhere near the same extent as China. It's not even in the GBIEM index yet. And for me, it's all coming down to market access. If you liberalize the market, you make it open and easy for people to invest without risks of repatriation, that's gonna work in your favor. And that's why we're seeing the flows in China, and we're not seeing that yet in India. So I just thought I'd take the baton from Lillian and answer it in the China-India context. With regards to your second point, the bullishness on the renminbi, I think I've covered it. I think it's an underrepresented currency, and the balance of power has shifted, right? And it's interesting. Would you still bet your money on an ongoing secular ascent of the US dollar when debt to GDP has now broken above 100%? It's the highest since on a post-war basis, or based on all of the arguments which I think all of the other panelists have also put to the table, and the linkage between China and EM and the standalone characteristics, would you argue differently? And I don't want to belabor the point. I think I've already said enough on that aspect.
Great. I think this question came up before, but I think to conclude, as we are approaching the end of our session, perhaps if I can go one by one and say, you're talking about an imperfect market. The information is either incomplete or incorrect when it comes out and gets revised dramatically. How do you devise your investment policy in response to that? And let's start with you, Bart.
Let's not forget quick, accurate testing and a vaccine are going to be the critical determinants of the economic outlook over the next 2-3 years. And how quickly that comes, how effective it will be the main driver. So the Fed has done what it does, central banks have done what they do, and now it's back to dealing with the heart of the problem.
Great. Let's see. Oscar, would you like to tackle it for Brazil?
Sure. I think it is very likely that Brazil can be impacted again by waves outside of Brazil. I think locally, you've probably seen the first wave continues around. I don't think the prospects of a second wave are particularly worrying. How do we protect ourselves, and how do you invest in that environment? We go very, very bottom up. We don't buy public equities. We don't buy indexes. We buy private companies where we can identify high yield and are very sort of bottom up in our analysis. And we only acquire them if the yield is so high that we believe that we are cushioned against volatility on the economic growth of the country going forward and the FX.
Great. In the remaining couple of minutes, again, Lillian first and then Ray second. How would you tackle it from a Chinese viewpoint, dealing with imperfect information?
Yeah, so I think imperfect information actually works in our favor, because if everything is perfectly transparent, then there is no value add for any stock pickers, and that's where our value is. So we actually like imperfect information, and that's why for our bottoms up research process, we actually have a full-time team in Shanghai, which is where I was born and raised, actually. That we have to verify and check every single piece of information that we get. Even on the macro data, we see the aggregate numbers, but we verify with all the companies that we're in touch with. So like I said, macro is in aggregation of micro. What we're seeing has to be consistent with the macro level, and that's how we add value, is really to look for those imperfect information as our opportunity to add value to our investors.
Wonderful. Thank you, Lillian. Ray, a very quick answer before we sum up.
Okay, very quick one. For me, ESG matters everywhere, but even more so in the world of emerging markets, precisely because of imperfect information. So we need to be forward-looking about it and not just look at static information, but look at how we engage with these sovereigns and these corporates. And I think that's key in a world of imperfect info in emerging markets. And it's going to lead to better results at the same time.
Thank you all very much. Bart, Lillian, Raymond, Oscar, you've given us a great flight around the world of emerging markets for the investors. Thank you all very much for your time, and we appreciate the audience joining us. Have a great day. Thank you.
Thanks, Rui.
Thank you very much.
Thank you very much.
Thank you.